Everybody, this is John. It is about 8:25 in the morning on Thursday, and I was looking at the markets here a little bit pre-market. So NASDAQ here, up about 7.5 points. We'll kind of see where that ends up at the end of today. Obviously, the markets here are getting under pressure. We've got an interesting battle going on here. Again, the daily downtrend versus the weekly uptrend. I think what's going to happen is we're going to stay in a daily downtrend until we get to this weekly uptrend, and then things are really going to get interesting. So how do we trade this, and how do we try to be most consistent? So part of this is just not blowing up, setting up trades in such a way that fit into this. And one of the biggest misconceptions about trading earnings is that you either make a steady amount of money, but there's always the off chance that you're just going to blow up your entire account. Well, the thing is if you do the earnings plays correctly, that's not going to happen. So Facebook had earnings. Let's see the earnings play that we did on that. Now, and when I say do earnings trades correctly, it doesn't mean that everyone's going to work out, but it's the ones that don't work out are going to really minimize the losses there and maximize gains. So on Facebook, there's an expected move of $5. Okay, for those of you that are newer to earnings play, what we're looking at here is leading up into earnings, the implied volatility explodes, and it makes especially the at-the-money options very expensive, okay? And they're so expensive, in fact, and one of the biggest mistakes newer traders make is that they get the idea of, wow, some of these companies have big moves. I think what I'll do is I'm just going to buy, some puts and buy some calls and buy a straddle, and that way, whichever way it goes, I'm going to make money. But of course, the market makers know this, and they price it in where essentially Facebook has to have a greater than $5 move to the upside for the straddle to make money, or a greater than $5 move to the downside in order for the straddle to make money. All right. If it has a movement less than that, then whoever sold these actually makes money. So that's what I did. I sold the 76 half calls for $2.67. And I sold the 76 half puts for $2.82. Now, I didn't want to have naked exposure, okay? And that can be a little scary because if the stock, is up 20 points the next day or down 20 points the next day, that could really hurt. So I bought protection. So if it went above $82, I'd be protected. And if it went below $70, I'd be protected, meaning that my maximum loss would be manageable and very specific and not a surprise. So if we look at this, we can see that, wow, if Facebook gets killed and goes to 70, my maximum loss is going to be $2,460, okay? If it opens up flat and the implied volatility collapses, or if let's say it closes here at the end of the week, then my max profit is $4,000, okay? And then if for some reason it explodes to the upside, my max loss is $1,400. And I did skew it a little bit in favor of protecting the upside just because some of these tech stocks have actually had some pretty good moves. Now, I don't expect to get max profit. I typically, on something like this, I'm looking to kind of get somewhere in here. And we'll see how it opens up here and just kind of see how we want to manage it. Okay, so the market's going to open in 25 seconds. So keep an eye on this. So here we have the closing price. Here we have the bid-ask after hour, or pre-market. So it looks like it's going to open up about 50 cents. But what I want you to keep an eye on are these options here, the 76 half call, and then look at my P&L. Okay, so 5, 4, 3, 2, 1. The market's going to open, and it's going to take a minute for things to settle down. Okay. Oh, awesome. I love that when that happens. And there we go. That's my alarm to drink water. Great. Got it. Okay. So TradeStation charts just kind of overwrote there. All right. So now immediately at the open, these calls, which were $2.60, are now have dropped in value to $1.12. The puts, which were $2.82, dropped in value to 83 cents immediately, okay? And now you can see here that the profit that we had. Now remember that the max profit on this trade is $4,000. And so one of the questions comes up is, well, should we hold it to the end of the week to try to get max profit? And the answer to that is no. Okay, at this point, it's a different, once the market opens, it's a different risk to reward scenario. Okay, prior to the market opening, it was a very clear risk to reward ratio because we were playing the implied volatility collapse, okay, which is essentially what's happening here. Now, we could give it a few minutes and just kind of see how Facebook is going to act here. But ultimately, we've made our money, and we want to take that money and run for the hills, okay? Now, when you're closing something out like this, you don't actually need to close out the long options, okay? That's a lotto ticket. You're only going to get 6 cents for this. You're only going to get a nickel for this. What you want to do, all the risk is in these short options, okay? Because if Facebook rallies $10, then that short option is going to, go negative, right? So the only thing you have to worry about here is just buying back the short options. Okay, so now we can see that it's actually coming down pretty good. That's going to increase our profits. Okay, the closer we are to 76.50, the more money we're going to make. But again, at that point, at this point, there's really not much else to do. Okay, so what I'm going to do is I'm going to start covering the short options, and then I'm going to text this out because this is a trade that we put in the trading room, just letting people know, like, hey, this is what I'm doing here. And so I'm just going to come over here and say, let's buy those 76.5 puts back. Midpoint right now is 85 cents. Let's see if we can get that midpoint and not give the market makers the satisfaction of kind of skimming the cream off the top there of the trades, as they are prone to do. And then let's also buy back the calls, which right now are $1.22, and yeah, you can see that midpoint. So the market makers still have a fairly wide bid ask. They're trying to kind of cream it off the top there. Let's go. It's like, this is always a fine line. I don't want to be a dick for a tick, but I don't want to pay the ask either on something like this. All right, so those orders are working, and we're sitting here at 50 cents, up 50 cents or so. And let's give this a few minutes. Okay, there. So I just got out of the puts. So great. Now we've taken a lot of risk off the table to the downside, and now I just want to get out of the calls. Now you can see that the stock is moving up in price. Remember, I don't want to be, dick for tick, so to speak. And right now my order is, I'm trying to get out at $1.10, and the option's at $1.26. All right. Now, if this price continues to move higher, then that's something that I'm going to have to take into consideration. At this point, it's kind of just hanging out here at 73 cents or so. So now what comes to the point is I'm trying to get out at $1.10. You can see we're at $1.19, $1.20, and do I just why am I going to fight over 10 cents here? I mean, this thing could really take off, and now it's starting to take off, right? It's like, darn, okay. So is it a big deal? Do we have to, is it a win or a loss on what price we get out at? And the answer is no. I mean, if you start off with $1.10 and that's not working, that's fine. We can go in and change it. You can see it's not having a dramatic impact on our position, right? We're talking, pennies and nickels here. So I'm going to go ahead and change this. Let's cancel and replace that order, because remember, we've already made our money. And now you can see that this has jumped up. So instead of $1.10, we're at $1.46 here. So it's actually jumped up about 40 cents, right? And the stock continues to climb. Now, the thing here that a lot of times a trader will do is just freeze and say, oh my gosh, if only it'll come back down. And that's not what we're talking about here. We're talking about, we put it in an order, it didn't get filled, and now we can see that the stock is rallying, and we want to focus on what? The risk, okay? The risk, not the reward, not how much money we could make if it would come back down. All right, so now you can see that Facebook is up $1.33, and I've got an order in by Facebook. I think it changed. Maybe it didn't. Let me come back in here. Sometimes, if you guys have ever traded and recorded what you're doing at the same time, okay, so great. That's awesome. It didn't change. That can be a lot of fun. Okay, so let's try $1.70. So, pretty much, all right, confirm, send, and see if that's going. Oh, you know what? I didn't hit enter. the joys of trading while trying to record it live. It kind of sometimes messes with your brain. That's okay. So, by the way, FYI, if you're going to change your price like this, that's fine. What I did not do is I did not hit enter there. So now I hit enter, it's locked and loaded, and now it'll actually change the order, and now I'm out. Okay, so left a little bit of money there on the table. Ultimately, it's showing an open P&L of minus $1,000. Of course, that's from these options, which are expected to lose money. But my P&L on the day of $2,070. Okay, so that worked out pretty good. In a perfect world, just would have held on and let those sold options expire worthless. But this, to me, was a nice, easy, conservative way to play earnings, which have a reputation for being pretty nasty. So then the last part of this too, in terms of consistency, is you want to structure your portfolio in a way to kind of handle whatever the market's going to throw at you. Okay, so Apple's acting great, so we'll just have bullish positions here on Apple, right? For AMBA, it's a little sloppy here, but got some bullish positions on here, nice limited risk. Diagonal here, we can actually buy back that $60 call and roll it out into a new one. So it's not busting through support or anything like that. That's fine. CMG, a little quiet here. We got a diagonal on that. Facebook, that's the one, of course, we took the profit on, so that worked out well. And then I've got puts on the Qs as a hedge. You can see right now that those are underwater, but I've got those there on purpose as a hedge in case the market rolls over because of my long risk. Okay, and then to the downside, I've got call credit spreads on Tesla and then call credit spreads on LinkedIn and some put debit spreads. And so ultimately then the idea with this is that you have a portfolio that's constructed in such a way as to promote the most consistency no matter what the market throws at you, all right? So, all right, guys, we are kind of in the last final stages of our consistency, my consistency class on Saturday, all right? So what are some of the things that we're going to be talking about? Part of a big, and I know you guys can read these bullet points, but I'll kind of, the stuff that to me is kind of on the top of my mind after watching the markets today. But a big part of it is an easy way to quickly hedge with a little trick in terms of viewing your deltas, okay? You may not even know what that means, and it doesn't matter, but it'll let you know how many QQQ puts, for example, you need to buy to hedge, or if you're mostly short, how many QQQ calls that you would need to hedge, and when and why you would do it. And it's very specific, and it's not a like, ooh, maybe should I do this, or it's very, very specific. And that's one of the best ways to keep a consistent equity curve, because it keeps your balance, also known as the net liquidating value, the same. So if you've got a bunch of long positions that are going down, but you hedged in time and your hedge going up, your balance stays about the same. And that's an art form in and of itself that a lot of people don't think about, and it's actually super easy. But then also structuring your portfolio in a way that you can sleep at night. So the next morning when the markets, are going nuts, that it's not a big deal for you, okay? What are the best option setups for these strategies in terms of consistency? But in addition to all this, I'm a big believer in consistent income. But in addition to all this, structuring your portfolio in such a way that you can have the occasional EKG spike. Okay, so a lot of this is going to be very specific strategies. We're going to be talking about how much of your account to risk, and then psychologically how to stay on track. And a lot of times what I'll hear from people is like, well, gosh, I was doing good for a week, and then I just kind of went into this death spiral. And there are specific things that I want to share with you in terms of the mental game of this and the checklist that I use before each trade. Okay, so this class, if you're seeing this, go down to the bottom. It is $297, and looking forward to sharing this information with you on Saturday, and we'll talk to you then. Bye-bye.